All right, we're on objective 5.4, and we're going to do 5.4 and 5.5 in this video. And I promise this one won't be as long as the last one. I try really hard not to make these videos long, but I really felt like those two needed to be together. So here we go. We are going to talk about adjusting and closing the accounts of a merchandising business. Remember, chapter 3 and 4, we learned chapter 3 was adjusting entries, chapter 4 was closing entries. So now we've added merchandise inventory, sales, cost of goods sold. We've added some accounts, so we need to figure out and remember how to adjust and close them as well in the process. Okay. A merchandiser is going to adjust and close accounts in a very similar manner to service entities. We just now have some different accounts. Okay. And the biggest one would be inventory shrinkage. And I mean, my husband used to be an inventory control manager. You could grow inventory. Sometimes they put it in the wrong place one day and you make an entry to take it out, and then you find it in another aisle the next day and you have to add it back in. Okay, so that was the bulk of his job. At the end of every period, even though in perpetual we're making sure the ending inventory is always correct, we still have to physically count it to make sure, because we don't know if somebody stole something. They didn't stop when they were walking out the door with it and say, "Hey, make sure you take this out of your inventory. I stole it." They're not going to do that. Things get damaged, and sometimes workers don't know the proper channels to actually take that out of the inventory. Some do. Okay, so inventory shrinkage is one of those. And so adjusting that, so it said Smart Touch Learning's merchandise inventory count shows an unadjusted amount of 31,530, but a physical count comes to 30,000. Okay, so we know that that extra $1,500, it is either damaged or it was stolen. Because we know in a perpetual system, we know what was sold. We don't in a periodic system. A periodic system, we just know so much left the building in this year. It was sold, or it was stolen, or it was damaged. We don't know for sure. We don't have a separate count when we're using periodic inventory. That's why perpetual is better. Okay, so this is just an adjusting journal entry just to get the inventory down to the amount that it's supposed to be, the 30,000. Okay, closing those accounts, you're going to make those revenue account zero. What does this look like? This looks like the closing process, doesn't it? Close the revenue accounts, close the expense accounts, and then you're going to close those um, to income summary, because remember, we calculate the net income or net loss. So we will close the income summary. And then the very last step, we would close the withdrawal account. Probably a merchandiser is probably not going to be a sole proprietorship, but nonetheless, that this is the closing process. If they are a corporation, these last two steps just get combined. It's not that big a deal, and we'll talk about that in Principles of Accounting too. Okay, so there's our adjusted trial balance. We have in blue, those are the new accounts that we have. Remember, everything, all those, all sales, revenue accounts, and all expense accounts are all temporary. They all get closed. Okay. And the withdrawal account gets closed. Remember your little acronym: revenues, expenses, and withdrawals. Okay. So they're going through this process here. I'm not going to go through this because we just did this in chapter 4. Okay. So we closed the revenues. Here was that closing entry 1. There's the revenues. We closed the expenses. We had net income of 99,420. We closed that income, that net income, into the capital account right here. That is net income. And then the owner took 10,000 out, and there is the 10,000 they took out. Okay. So that looks just like what we did in the previous chapter. If that is foreign to you, you probably need to go back and review chapter 4. Okay. Here's the journal entries. Notice we're getting a lot more expense accounts. We only have one revenue account, and that typically happens This journal entry can get really long when you're closing the expense accounts out. Okay. And then this is 1, 2, and then here is 3 and 4. Those are the journal entries. Just because it's in a T account doesn't mean it's in the accounting system. Okay. The last thing we're going to look at is objective 5.5, and we're going to look at the financial statements. I've already kind of talked about a single step and a multi-step income statement at the beginning of this chapter. So here's a single step income statement, and I really like this one because this is a merchandising business. You can see the cost of goods sold right there. The only number we have is net income. We don't know anything else. And so in a merchandising business, this single step income statement doesn't give us a lot of information. It doesn't give us good information. A multi-step income statement is going to give us more information. Okay. So let's come down here and look at this multi-step. Okay. So we kind of have this first section. You're always going to see net sales revenue minus cost of goods sold gives us gross profit. Okay. Then we have our operating expenses. We have selling category and administrative category. And then we get to operating income. Okay. We don't have this number or this number on a single step income statement. We're going to separate out that other income. Interest expense and interest revenue would also be in this little category, because that kind of pulls that out and like puts everybody on a level playing field, because some businesses might have had a lot more cash and earned a lot more interest revenue. Others might not have had a lot of cash and they had to borrow. So this number we can compare to other merchandisers. We can compare their operating income. Okay. Then we had that expense, and then that brought the net income down. So net income was exactly the same. I said that in the very first video, but we get all these other totals that give us a lot of good information. Okay. And we're almost done. Okay. Those other examples, I said interest revenue, sales discounts for forfeited interest expense, and gains and losses on the sale of plant assets. I want you to think about this really quick. It's not every day that you sell a Walmart building, okay? Or you sell a McDonald's, the building that's there, okay? So we separate those out because that's not something we are doing all the time. They're kind of extraordinary, kind of out of the ordinary. So we do put those down in the other income and expenses. We're not going to put them up top because they're not the thing. That's not what we're in the business of doing. If we're Walmart, we're in the business of buying and selling stuff. We're not in the business of buying and selling buildings. So that's why it needs to go down in the other. If if your business is in the business of buying and selling buildings, then yes, that's your net sales and gross profit. And that's what your business is there for. Okay? So you just got to think about, what is my business? What are we doing? If it's something that's kind of out there, not similar to your business plan, then it's probably going to go in that other income and other expenses. Okay. The statement of owner's equity and the balance sheet aren't going to change a whole lot. You'll have that merchandise inventory. We haven't really talked about this estimated returns inventory. You might see that. And you might see a refunds payable account on the balance sheet. And that is all for chapter 5. I will see y'all in the next chapter, chapter 6. We will still be talking about inventory. We'll be doing a little bit more with it then.